So today we're going to start talking about leveraged buyouts. We're going to do that both today and tomorrow. We're going to build a leveraged buyout model, keying off the model we built in class last week. So what we're going to do, it's kind of an interesting exercise. We're going to put ourselves in the shoes of a private equity firm. We're going to assume that we all have a private equity firm. We're buying company A as part of a leveraged buyout. And so we're going to modify that financial model to reflect the new capitalization structure associated with that LBO. So we'll start building that model today. We'll get about halfway through. We should, by the end of today, get up through the point of having a pro forma balance sheet put together. And then tomorrow, we'll start modifying the rest of the financial model, all of our income statement, balance sheet, cash flow, debt schedule. And then we'll finish up tomorrow by doing a returns analysis. We'll also probably go and show you how to do to use a leveraged buyout model as a pseudo fourth valuation methodology. All right, so that's pretty much what we're going to cover both days. And then next weekend we'll get into M&A modeling, and then we'll talk about pitching and the M&A sale process and finish up on Sunday with recruiting. So that's kind of the roadmap the rest of the way. Slides are in the back table, as are the instructions for the LBO model that we're going to be building. So we'll get to those a little bit later. First, I want to talk a little bit about what LBOs are, what is contained in the model, why they're built, both for folks on the buy side, that is a private equity firm, as well as folks on the sell side, an investment banker. All right, so we'll talk about that. And then obviously we're going to build a model. We're going to go through and we're going to build a model that contains a purchase price calculation and calculation summary. We'll do a source and uses of cash, because that's really important. There'll be a lot of different things going on with the capitalization of the company. We'll be raising a lot of debt. We'll be refinancing some old debt, raising some new equity, buying out some old equity. We're going to have to pay some fees. All right, so the sources and uses of cash is going to tell us where all those pieces of cash are going to be coming from and how they're getting used. We'll analyze the capital structure of the deal. That is, how much debt will we have, how much equity. What does that look like relative to the purchased or to the target's EBITDA? That is, what is the multiple of debt to EBITDA? What is debt as a percentage of the total capitalization? We will then create a pro forma balance sheet, which we'll talk about a little later. It basically is a balance sheet immediately after the transaction is completed, giving us a snapshot of what the company will look like with the new capital structure in place. We'll then integrate that into the financial model. And then, like I said, tomorrow we're going to get into modifying our income statement, balance sheet, cash flow, debt schedule. We're going to have to change a lot of the links that we built last week in our model. We're going to have to modify our debt schedule because we'll have some different pieces of debt. We'll have some different terms associated with that debt. We're going to model for PIK interest, payment in kind interest, tomorrow. All right, so we'll see a lot of different things that we haven't seen yet. And then finally, we'll do the IRR analysis. Basically, what is the return to the sponsor, the private equity firm? What is the return to the hybrid debt lender? Another word for hybrid debt is mezzanine. So what are the returns to the mezz lender in the deal? And then we'll do some sensitivities. We'll calculate some credit ratios. And like I said, we'll probably also do an LBO valuation. Let's talk about what we built, what the model actually entails and why we build it. But before we get into that, first of all, I want to ask, what is an LBO? I want to make sure everybody knows what we're talking about. We're all on the same page. What is a leveraged buyout? Yeah, we're basically using a lot of debt to finance the purchase of a company. All right, so we're borrowing as much money as we can, putting in as little of our own money as we can get away with, to buy a company. Why would we do that? We've talked about debt having a lot of risk associated with it. The more leverage a company has, the more risk associated with that company, both to the debt holders as well as the equity holders. So why would we do this? Magnifies returns. Debt juices returns. So let's go back to my favorite example of a house. All right, it's the house that we talked about in class 2 when we introduced the concept of enterprise value. Let's assume we're buying a house. And typically when we buy a house, the way we do it, as we talked about before, we've got to go in, put down some equity, and traditional transaction is going to involve us putting down probably about 20% in equity and financing the balance in the form of a mortgage or debt. All right, so our capital structure is 80% debt, 20% equity, if we want to think of it that way. All right, well, let's assume a year from now we're able to, and we sell this house for $600,000. All right, so we're in a rising market, kind of hard to imagine what that might look like these days, but we're able to sell our house for $600,000. What's the first thing we need to do at that point? Yeah, you got to pay off the debt. All right, we can't just walk away with that. The mortgage holder has a first lien on the asset, so we've got to pay off our debt. All right, so we pay off $400,000, leaving us with $200,000. And I'm not taking into account fees or taxes or anything like that. We're keeping it really simple at this point. So we assume that $200,000 is basically left to equity, to us. $200,000 can go in our pocket, right? Well, our return, if we put down $100,000 and we get $200,000 at the end of year one, it's a 100% return, right? Pretty good. Not bad for 1 year, especially in real estate these days. All right, but let's assume now we can finance this a little bit differently. Let's assume now we go out and we really aggressively shop for debt, and we find a lender that's going to allow us to only put down $50,000, which obviously means the balance is $450,000 that gets financed in the form of a mortgage. Same scenario applies. After a year, we sell our house for $600,000. We pay off our debt, $450,000 in this case, leaving $150,000 to go back to equity. In overall dollar terms, it's less money, but remember, we put down a lot less. We only put down half of what we did in our first case. So this 50 has become 150. It's tripled in the span of 1 year, which equals a 200% rate of return. By borrowing more, we've been able to double our returns from an IRR or percentage perspective. Does that make sense? All right, so when we say leverage magnifies returns, that's what we mean. And this is basically the idea behind leverage buyouts. Private equity funds, the way they are set up and structured, if we had our own private equity fund, we were all the partners, private equity fund, and we were structured such that our returns, the amount of cash we get at the end of the day, is based on this number here. We're incentivized to maximize this at all costs. All right? To the extent that we get over and above, we achieve something over and above our quote-unquote hurdle rates, which we'll talk about in a moment, then after we've done that, an increasingly large percentage of the distributable cash from a deal starts coming our way in the form of what we call carried interest. Right? Leverage buyouts are not being done right now, as we probably all know. It's probably one of the toughest times in history for the buyout industry for private equity, mainly because this piece is absent. Private equity firms can't get debt. The debt markets are very unreceptive to highly levered transactions right now, so it's very challenging for private equity firms to put these structures together. Most private equity firms right now are focusing on portfolio management, trying to make sure the investments they have in their portfolio can be salvaged and that they don't lose too much, or that they can find a way to exit those investments somehow and still get some returns back to their investors. All right? But it's cyclical. Private equity, leveraged buyouts, very cyclical industry. Out of favor right now, but will come back. All right? Definitely will come back once credit starts to loosen up a little bit. All right? This structure, and one reason I use real estate as an example here, this structure, this leveraged buyout structure, very similar to what gets done in commercial real estate. Okay, so when we first started talking in class 1, one of the first things I said was there are a lot of different applications for what we teach in class beyond just banking or private equity. Commercial real estate is one. And this is where this leveraged buyout modeling especially really gets heavily used in a very similar fashion in commercial real estate deals. Anyone's worked in commercial real estate the last several years, notably 05 to 07, This is very similar to the structure that was getting done, not necessarily for a single-family house or home, more for purchases of office buildings, apartment buildings, industrial, etc. So commercial real estate deals, when times are good, are also very similar to leveraged buyouts, and those will come back as well. Let's talk about a model, what it's being used for on the buy side. So from a private equity firm's perspective, let's talk about what they put together in the form of a model. Again, the goal of an LBO is to acquire a company using as much debt as the cash flows of the company will support, putting in as little equity of our own as we have to do. And obviously we just covered this, the more debt we're able to use, the less equity, the more debt we're able to gain. All other things being equal, the higher the expected internal rate of return on the deal. And one of the key reasons that we put together an LBO model is, at the end of the day, to figure out what is that rate of return going to look like. Our decision as to whether we, the private equity firm, are going to do this deal in the first place is largely going to be based on this, again, because this ultimately will determine what percentage of the cash flows will come to us and how much cash, how much are we going to be able to take away. All right, so we build these models, again, as we talked about when we introduced the concept, we need several things. We need a purchase price assumption. We need to know what is our valuation going in to the deal, okay? We need to know how much cash do we need to raise. Right, so not just what do we need to pay the equity holders of the target company, but what do we need to pay in terms of the deal fees, banking fees, capital raising fees, legal fees, etc. Sometimes, in many cases, we'll refinance the old debt that's sitting on the target's balance sheet. And we'll talk about how we raise that cash. That is, what are our capitalization assumptions? How much debt, how much equity, where is it going to come from? What does each piece of debt look like in terms of its interest rate, whether it's current pay or PIK, that type of thing. If it's mezzanine debt, how much of a warrant or how much equity do we need to give up on the back end? We'll also show you how to model for that. And then we need some financial projections, either a model that we build, which we did last week, so we know how to build a model if we have to, or maybe a model that the target has given to us as we've discussed the deal with them, as we've gone through the due diligence process. And just like any other model, we want to build these models with the ability to run sensitivities, that is, change some of our assumptions, some of our key assumptions in the model. Typically, what will the deal look like if we change the purchase price? What will the deal look like if we change how much debt, the mix of debt and equity as we just did here? All right, maybe even change the operating assumptions of the company, revenue growth, margins, etc. As we talked about, PE firms typically have a required rate of return that they need to hit. Otherwise, the deal doesn't make sense to them because they're deploying capital, they're spending a lot of their time managing an investment that at the end of the day isn't going to result in a high proportionate share of the cash coming to them. All right, so these return hurdles, a lot of times for private equity, 18 to 25% is pretty typical. Real estate private equity, I know this right now because I deal with real estate private equity folks all the time. Typically low 20s, and a lot of time they're going to want to see cash on cash returns in the high single digits, low double digits. So pretty aggressive return assumptions. And as we saw here, if we take the opposite of this case, if we have to put in more equity and we can get proportionally less debt, then this return goes in the other direction. It goes down. Right? So it makes it more and more difficult to achieve those hurdle rates. We'll talk more about that a little later. But I think we all know the IRR is strongly driven by the amount of leverage. The amount of leverage, the more leverage we can get, juices our returns. And as I talked about earlier, leveraged buyouts are pretty out of favor right now because the debt markets are largely closed. If we can't get debt, this structure is not really available to us at all. Now, in the time, I wouldn't say the last several years, what I would say is really from the period, probably 2005 to 2007, leveraged buyouts were flying high. Very much in favor, tons of excess liquidity. lenders all across the board, whether banks or hedge funds, mezzanine funds, we're doing a lot of very aggressive deals, high leverage, light in the way of covenants. Right? Everybody remember what a covenant is? Basically a requirement of what the borrower must do or cannot do. Right? Those covenants were pretty loose for that period of time. A lot of deals had what we call PIK toggles. So the ability for the borrower to choose, do we pay our interest current or do we pay it in kind? That is, accrue it to the ending balance of our debt. Okay, and a lot of those things have really gone away, as has the leverage. Right? You're not going to see any deals these days, at least right now as we sit here in 2009, 1 year after Lehman's demise. We're not going to see any 4 to 6 times EBITDA deals in the marketplace these days. Right? But again, that will come back. Back in the 80s, a lot of deals were getting done 10 or 12 times leverage with a lot of junk bonds. So these things do come and go. I think it's safe to say we'll never get back to those days. But probably in a few years, we'll start seeing 4 to 6 times leverage deals again, I would imagine. But oftentimes what will happen is it's kind of an either or situation. The bank might agree to 4 to 6 times leverage on a deal, but require at the same time that the sponsor have a minimum equity contribution as a percentage of the total deal. All right, so either the leverage or the percentage of the total capitalization might effectively limit the amount of credit that gets extended. A lot of times you'll see 20 to 25%. I know in real estate deals right now, commercial real estate deals, a lot of times it's 30, 35, 40% equity requirements to get deals done. Now, LBO models, right? We say that building an LBO for the buy side. Well, lenders are also what we'd consider buy side as well. They're putting capital into deals as well. Private equity firms are putting equity in. Lenders are putting their capital in the form of debt. So lenders would also be considered buy side. And obviously, if they're putting capital into the deal, they're going to be building models as well. From a lender's perspective, it's really not so much what are the returns. It's really more, can we get paid back? Right? Can the borrower maintain ideal levels of interest coverage, maybe fixed charge coverage? Okay? Are we seeing leverage go down over the holding period? So once the deal, initially at closing, it might be a five times leverage deal. As the company grows their EBITDA, maybe next year it goes down to 4, 4.5. Year after that, 3.5, and 3, or so forth. This is really more the goal of an LBO model from a lender's perspective, right? Can we get paid back? What are the right covenant levels to set? And how sensitive are those covenants to changes in capital structure, changes in the operating assumptions? How much cushion do we have at the end of the day? Now, on the sell side, when we say sell side in the broader context, the broader industry context, we're talking about investment bankers. Okay, and investment bankers will build these models as well. Maybe they're advising a private equity firm or a financial sponsor on a deal. Okay, a private equity firm that's interested in pursuing an acquisition, or maybe we're representing a client and selling the company in a leveraged buyout type of transaction. All right. And in this case, we're really going to look at what are the range of viable purchase prices that still allow the sponsor to meet their required rate of return, still allow the lender to get paid back while maximizing the purchase price to our client. Okay, so pretty much any time there's a deal, leverage buyout, anybody who's involved is running a model. All right, the private equity firm's running a model, the lender's running a model, investment bankers running a model if they're representing the company on the sell side of the transaction, etc. And then again, as we mentioned briefly earlier, and as we'll see tomorrow, we can use this as a fourth valuation methodology, maybe to figure out what is the maximum purchase price that can get paid for a company in a leveraged buyout, and use that as a fourth valuation methodology in addition to the other 3 we've discussed in class. Kind of a fun exercise. We'll go into that in much more detail tomorrow. Let's talk a little bit about what the model is going to look like. We're not going to spend a whole lot of time here because, kind of like with financial modeling last week, it makes a lot more sense when we're doing it. So what I want to do is kind of outline the broad structure of what the model looks like, and then we'll just start building one. And then once we've built one, what I would say is go back, read the rest of these slides. These slides give a very detailed step-by-step approach to how to build an LBO model, and it'll make a lot more sense once you've actually done it. Okay, so what we're going to do today is we're going to take the financial model we built last week, same model, so those numbers are going to look very familiar to us, and we're going to now we're going to look at this company again as if we're the private equity firm evaluating a purchase of it. So we're going to have things like a purchase price assumption. We'll have a sources and uses of cash statement. Right? And sources and uses of cash, kind of like a balance sheet in one respect, in that sources of cash have to equal uses. Just like a balance sheet has to balance, source and use has to balance as well. If we need $500 million of cash to do a deal, we better be able to raise $500 million of cash, otherwise we're not doing the deal. So that's kind of what a source and use is all about. Capitalization, so we'll figure out how much debt, how much equity do we need, what does that capital stack or that capital structure look like, and we'll build, obviously, enough of a model to give us a sense for what the return is going to look like on the deal. All right, so the first thing we'll do today is we're going to build a purchase price calculation or a transaction summary, basically saying what is the valuation of this company as we buy it. Right? And this is usually a lot more than just putting together a table and pulling an EBITDA multiple out of the air and deciding that's the price. Usually what happens here, this is usually determined based on a full valuation analysis. All right, so the private equity firm is probably doing a comparable companies analysis, probably looking at precedent transactions both by strategic and financial buyers, figure out what the optimum value, the right control premium to offer would be, probably doing a DCF to arrive at a value. Our model is going to be a little more straightforward. We're just going to assume a multiple of EBITDA, apply that to the company's trailing EBITDA, that's going to be the enterprise value of the deal. But just recognize that in a real life situation, you'd probably be doing a full valuation in order to get to that. Okay, so we're going to calculate an enterprise value. We're going to then calculate what is the implied equity value of the deal. If we back out debt and add back cash, then it will give us that. Once we do that, if we know how much we need to pay for the equity, and if we're going to refinance the debt, and in most LBOs the debt gets refinanced, especially large transactions. If the target company has several different lenders that have lent them money, maybe in a syndicate, oftentimes it's just easier to completely refinance that debt and raise new debt as opposed to trying to go in and negotiate with a syndicate of 20 different lenders, trying to get them to agree to a radically different capital structure on the deal. That can, as you can imagine, that's probably a very difficult undertaking. Okay, so what we're going to do is we're going to buy out the equity, we're going to pay down, or we're going to refinance the existing debt. So we need to raise enough cash to do those things. And then like everything else in finance, we're going to have to pay some fees. We're going to have to pay some transaction fees. Going into the deal, if we're the private equity firm, one of the things we're going to have to do is pay probably a financing fee. We'll probably have to pay an investment bank to go out, help us raise the amount of debt necessary to do the deal. This would typically be provided by the leveraged finance group of an investment bank. Right? We'd have to pay them. Right? There might be, if we're getting represented by an investment banker sort of for M&A purposes, probably have to pay an investment banking fee as well. Or maybe we're big enough, maybe we do that on our own, maybe we don't engage a banker for that. In this model, we assume that we will. And then as always, we're going to have to pay the attorneys, we're going to have to pay the accountants, we're going to have some other due diligence costs associated with the deal. So altogether in this transaction summary, we got to buy out the equity, we need to refinance the debt, and we've got to pay fees. If we add all those things together, it will tell us how much cash do we need to raise. Remember, sources need to equal uses, so how much cash do we need to raise? And that's when we start working on our sources of cash statement, or our capitalization assumptions. What we're going to do is we're going to go through, we're going to assume that the company is going to have access to 4 different types of debt. We're going to have access to a revolving line of credit, then we'll go out and we'll raise a term loan, probably from a commercial bank, right? There'll be a senior secured lender, as we've talked about before, Chase, B of A, etc. We might sell some bonds. Actually, we're going to assume that we can sell some bonds here as well. Have a junior piece of debt, probably a second lien piece. And then finally, we're also going to go out and get some mezzanine debt to sort of round out our capital stack to get us to the optimum leverage that we need to get. Right? What's a mezzanine piece? Just for our refresher, everybody know what I mean when I say a mezzanine piece? Mezz piece is similar. It feels like debt, and then on the tail end, we're going to give that lender a little bit of equity as well in the form of a warrant. This is an unsecured piece of debt, so this lender is at the very, very bottom of the capital stack. Right, they're before equity, but they're behind two other lenders, and they're taking a lot of risk in the fact that they're not secured. So in order to compensate them for that, we need to give them a warrant. So we're going to be able to account for that. And then finally, we're going to have how much equity are we putting in the deal? So of the private equity funds, of our fund that we've raised, say we've got $1 billion fund that we've raised, in this case, we're going to put $104 million into this deal. Right? That is our equity contribution. All right, so that's sources and uses of cash. Again, at the end of the day, they need to be equal to one another, otherwise there's no deal. All right, so again, capital structure alternatives. I think we've talked about a lot of this. When we talk about the amount of debt we're going to raise, oftentimes we refer to that as a multiple of EBITDA. Remember earlier we talked about a lot of these deals being kind of 4 to 6 times EBITDA. The deal we model today is going to be 4.5. And each of these individual pieces, we're going to speak of them in terms of their multiple to EBITDA. So we're going to get a term loan of 2 times EBITDA. We'll get some senior bonds of 1.5 times. We'll get a mezz piece of 1x. And then the balance needs to go in as equity. That's that $104 million. We're also going to look at this not just as a multiple of EBITDA, but also as a percentage of the total capitalization. Another way to express leverage in this case is to say that debt is 72%. It's 72% of total cap. Leverage is 72%. Equity is 28%. And then we'll specify interest rates. In this case, we distinguish between cash pay and PIK because one of our pieces are unsecured notes. Another reason why it's more of a risky piece is because the lender doesn't get their interest in cash, they get it paid in kind. So it's just getting accrued and accrued over time. They don't really know exactly when they're going to get their interest paid. They're very dependent on the private equity firm's ability to exit the deal and take them out and pay them for that interest that's been accrued over time. And then in this case, one of our lenders, that mezz lender, is going to get a warrant. So that's where we're going to reflect that in our capitalization table as well. Once we know what our capital structure is going to look like, and I apologize for this being so small, we had to fit it on the page, but we're going to create what we call a pro forma balance sheet. So again, pro forma balance sheet, kind of think of it as what does the company look like a split second before the deal gets done? What changes or what adjustments do we make as a result of the deal? Remember, we're paying off some old debt. We're bringing on some new debt. Anytime a deal gets, most deals anyway, usually some goodwill gets created, so that will come onto the balance sheet. We're buying out the old equity. We're investing new equity into the deal. All right, so what does the company look like a split second before? What are our transaction adjustments to reflect all of those changes we just discussed? And then what does the company look like right when the deal closes? That's what we mean by pro forma balance sheet. And we need this for a couple reasons. Number one, it's interesting to see what the balance sheet looks like right after the deal, but we also need to integrate this into the model we build and really key off of this going forward. Especially when we consider our cash flow statement. Remember, the cash flow keys off changes in the balance sheet accounts. So that needs to be integrated. This pro forma balance sheet needs to be integrated into our financial model. We're going to do that first thing tomorrow. Okay, so we'll integrate that into our model as we see here. Create space for that. We'll drop that into our model. And then we are basically going to go line by line through our income statement, balance sheet, cash flow, debt schedule, and adjust for what this transaction means in terms of the company's financial statements. Okay, then finally, as I've said, the big goal here is to figure out what is this number, what are the returns. So once we have a sense for what the cash flows are for that holding period, private equity firms typically try and hold investments 3 to 5 years. They need to exit in a relatively timely manner so they can return capital to their investors. So we're going to assume a 5-year hold. We need to know what those cash flows look like for those 5 years. And then we need to make some assumptions as to what we think we can exit at. What is the value at the end of year 5 that we believe we can sell the company for? And once we have all of those things, we can calculate our returns. Okay, so we'll model the sale. In other words, at the end of year 5, we're going to model the sale as a multiple of EBITDA. That'll give us an implied transaction value. Just like over here, we get our total enterprise value, we pay off the debt, we get down to what's left for equity. Actually, we pay off the debt, we pay off fees. We get down to what's left for equity. That gets split between the private equity fund and that 5% to our mezz lender. So we know what percentage of the deal goes, percentage of the distributable cash goes to each, and then we create our returns analysis. Basically an IRR analysis, internal rate of return. If you've ever done that in Excel, it's pretty easy to set up. And this is the IRR table that we're going to create. And ultimately, at the end of the day, this is the number we're going to key on. We're going to compare this IRR. In other words, if this is a 19% IRR, how does that compare to our hurdle rate? If our hurdle rate is 25, then it's probably not that good of a deal for us. If it's 15, this might be something worth considering. All right, so at the end of the day, that's where it really depends on what is our hurdle rate, what is the relation to the IRR implied by the deal. We'll also do an IRR for the mezz lender because they're getting something more than just their interest and their principal paid back. Okay, they're getting value in the form of that warrant, so their IRR is going to be a little different than just their interest rate. We'll calculate what that return looks like because at the end of the day, the mezz lender will also have a return hurdle. That is some benchmark that they need to achieve in order to maximize their own returns. If the deal implies a 13% IRR, if their hurdle's 12, might be a good deal. If it's 15, may not be so good. Same logic applies. All right. So at this point, let's actually break away from here. What I want to do is go into the model and actually build it. Once we've done that, then I want you to be able to come back, read the rest of these slides, review even what we've just covered. I think it'll make a lot more sense at that point. That really just introduced the structure of the model. All right, so I'd gone into my folder 4-5 LBO modeling, and I've opened up the file LBO model shell. Same exact file you have. And what we're going to do is we're going to use these assumptions that were on the back table there. We're going to use these assumptions and the instructions here to walk through and build an LBO model. And this is something that if you look at these instructions in kind of a general sense, they can be really useful if you see an LBO model or if you have to build one sometime in the future. This can give you a sense of all the different things you need to do. So this is valuable. I'd probably keep this and you can use it as a frame of reference at a conceptual level. Everybody able to open that model, that shell? Okay, first thing, let's make sure that we're running in manual mode, just as we did last week, and that we're set up for iterative calculation. My model is, yours should be as well. Right? If it's not, make sure you check manual, make sure you enable iterative calculation. Again, that enables Excel to handle that circular logic that must exist in our model. Let's look at these tabs just so everybody can navigate around a little bit. We've got 4 tabs across the bottom. The first one is our source and use. These tables should look pretty familiar. It's exactly what was in the slides. We're going to go through and populate these. Okay, so the first thing we're going to do is our transaction assumptions. We'll build a source and use. At that point, we're going to go to our pro forma balance sheet. So control page down will take us to our pro forma balance sheet. Okay, we're going to link to our historical. We're going to do the transaction adjustments. We'll get our pro forma balance sheet on the right-hand column. I'm not going to really make we'll make very few changes, I believe, to the assumptions tab. We're going to leave a lot of the operating assumptions alone. We're going to just assume that we buy into the fact that the company is expected to grow 5% a year and have 60% gross margins and all of that. Okay, but in a real world scenario, you might make some adjustments here on the operations side as well. And then finally, we're going to work on our model tab. This should look exactly familiar. This should look very familiar, exactly what we did last week. Okay, so we're going to then model. We're going to modify this model to account for the LBO. We're going to insert a column here, drop in the pro forma balance sheet, and then make some changes to all 5 years in our forecast period. All right, well, let's go back to our source and use tab. What we're going to do is we're just going to start building the model off of these instructions. So right at the top, and I'm on the side that has the IBI logo. That's the first page. So right at the top of the first page, our transaction date or our closing date is going to be December 31st, 2008. So in that cell, I want to enter 12/31/08. You'll see that it's pre-formatted, just like all of our other worksheets here. Right, our hard codes are blue. Our output is black. So closing date of 12/31/08, that's the day we assume we're going to buy this company. We're going to buy it as a multiple of its latest 12 months EBITDA, so the next thing we need is 2008 EBITDA. We don't want to hard code anything here because we can actually go to our model. So that's what I'm going to do. I'm going to link to my model. I'll say equals, and I want to go to cell G25 on my model tab, EBITDA of 60 million. Right, next thing we're assuming, and again, this is an assumption for our purposes. In real life, you're probably going to do a full valuation in order to figure out what the implied enterprise value of the deal should be. In this case, we're going to assume we're buying the company in a multiple of 6 times EBITDA. So I'm just going to hard code 6 in that cell. And then my transaction value, my enterprise value, is just the product of my 2008 EBITDA, multiplying that by that 6 times multiple. So B6 times B7, which gives me an enterprise value of 360 million. Well, the next thing we need to do is we need to calculate what does that imply for the equity. What is the implied equity purchase price of the deal? What we calculated is 360, that's the enterprise value. Let's look at it specifically to equity because that's part of our uses. Part of our uses involve buying out the shareholders of the company. Another part involves refinancing the old debt. All right, so first thing I want to do, if I need to calculate equity value, I'm going to work backward through my total enterprise value formula. We're going to subtract the company's existing debt as of 12/31/2008. So I want to say minus sum, minus SUM, left parentheses. And let's tab down to our model tab, control page down to our model tab. I want to go to my balance sheet. And I'm taking the sum of cells G67 through G69. I want to select all of those pieces of long-term debt. If we had a current portion of any of our long-term debt up here, we'd want to pick that up as well. In this model, we don't. Right? It's just these 3 cells, the revolver, the term loan, the unsecured piece. Right, once we've highlighted those, we can hit enter, and you should have minus 190.8 for less existing debt. Just like always, we add back cash, so I want to say equals, control page down to my model, select balance sheet cash G47, it's 0, but we do want to establish that link, we don't want to hard code. Right, so equals G47 on the model tab, hit enter. And once we have those items, and again, if we had preferred stock, if we had minority interest, we'd want to take those into account here as well. Same rules apply in our total enterprise value formula. In this case, there's no preferred, there's no minority interest, so we've just skipped those. But just be on the lookout for those in the real world. And now we've got those 3 line items. The way we've set it up, if we just add those 3 together, it will give us our implied equity purchase price. I'm going to say equals sum, and select cells B8 through B10. When you hit enter, you should get 169.2 million. as our implied equity purchase price. Okay, well now that we know what we're buying the equity for, we know how much debt we are refinancing, we can start working on our uses table. Right? Because those are the two biggest uses of cash in this model. Buy out the equity. So equity purchase price, we're just going to link up to what we did above. So I want to say equals B11. I need to pay down my existing debt. And here I could do two things. I could link to my balance sheet as I did above, or I can link to what I did above, but I want to change the sign. All right, this is a negative. Here I want it to be a positive because I need to add up all of my uses. All right, so what I want to say is minus B9. And you should get a positive 190.8 down here. Now, as we talked about earlier when we were going through the slides, we also talked about having to pay fees. Right? All transactions have fees associated with them. So again, for the debt that we're going to raise, we're going to have to pay some financing fees. We're assuming we've got to pay some investment banker fees. Right? We've got a banker representing us, helping us put this transaction together. We've got to pay our lawyers. We've got to pay our accountants. So our fees, we've outlined these assumptions on the instructions page. Our financing fee is $8 million. So we're just going to hard code that. $4 million for banking, $1 million each for legal, and other fees and expenses. Another way you might see this in the real world is you might have these be variable fees. In other words, as a percentage of the overall deal value. Okay, so you can easily set that up. You know, your banking fee might be 50, 75 basis points for buy-side banker. All right. Maybe the legal and other fees are fixed, all right, but you can set them up to be variable if you need to. Now, once we have those, we can just add all the items up above that. Actually, here we can use alt equals for that quick sum function. Remember we talked about that last week. It will give us the sum of all of these items. When you hit enter, it'll give you $374 million. That's the amount of cash we need to raise in order to do this deal. Pay off the equity, refi the debt, and pay our fees. And if there are other fees associated with the deal or other uses of cash, we'd want to capture them all here. In real estate deals, there are a lot of different fees. There's appraisals, there's phase ones, all kind of different things that get included in that. Broker's fees, same concepts apply. And as I mentioned earlier, cardinal rule, sources have to equal uses. What we're going to do is we're just going to set our sources equal to our uses. Okay, so over here in cell F23, I'm just going to link directly to B23. I know at the end of the day, if I don't come up with $374 million, there's not a transaction, so I'll just link those up now, and then we'll back into some of the other items in our capitalization table. Let's start working through our capitalization table. Here are going to be all the various places where we can get cash to do this deal. If there was balance sheet cash on the company's, on the target's balance sheet, we might be able to use that. All right, so we're going to link that up. I know it's 0, but if we're working off of projections, if we're not quite at year end, maybe that number is going to vary a little bit. So we want to link that. If there's any cash, we're going to apply that. We're going to turn around and give it right back to the seller. Next item is going to be our revolver. The way we're going to use a revolver here, and it can vary depending on what the transaction actually looks like. In this case, we're going to use our revolver to fund any shortfalls. Okay, so if we can't raise enough debt from the other sources, or if we can't put in enough equity, we're going to have the revolver pick up the difference. All right, let's just skip that for now. I think it'll make sense. Once we get the other sources populated, we'll come back and do that last. Right, so let's move on to the term loan. And as I mentioned in the lecture, our term loan, our senior bonds, our unsecured notes with warrants, we're going to refer to these in terms of their multiple of EBITDA, in terms of the leverage that lenders are going to be willing to give us. So in the case of our term loan, what we're going to do is we're actually just going to put some multiples in here and drive our debt amounts off of those multiples. For the term loan, again, it was two times. For the senior bonds, it was 1.5x. For the unsecured notes with warrants, 1x, 1 times. All right, and this is where the Lev Fin group of our investment bank is giving us guidance. It might be a situation where they have actual numbers, so we enter the actual numbers here and then calculate the multiples. You can do it either way. All right, here I'm entering multiples and having them drive off of that. So the way our term loan is going to be calculated is we're going to take our multiple, we'll say equals G18 times EBITDA, B6. But I'm going to copy this. I'm going to copy this formula down to these cells. They're going to be set up exactly the same way. So if I want to copy this, before I do so, I want to lock on that reference to my EBITDA figure. So I'm going to hit F4. So in other words, the formula should look like this. It should say equals G18 times $B, $6. I've locked on that reference to my EBITDA number. When you hit enter, you should get $120 million for the term loan. And now we can copy this down to the senior bonds and down again to the unsecured notes with warrants. Does that make sense? Now the one thing that I notice here, mainly because I built the worksheet, is that this unsecured notes with warrants, actually this cell is formatted to have an underline in it, just like this one does. So when I copy this, when I paste actually, I hit Control-C to copy, and then when I paste down here, I don't want to just use Control-V to paste, as I might otherwise do. I want to use my, which shortcut do I want to use? Who knows? Pardon? Alt-ESF. Paste special formulas. All I want to copy here is the formula. I want to keep the formatting and everything else about those two destination cells the same. And when I say Alt-ESF, it means just paste the formula. Alt-ESF, hit enter, and then because we're in manual mode, hit F9 to recalculate. And you should end up with values of $90 million for the senior bonds and $60 million for the unsecured notes with warrants. Now once we have that, next thing we need to do is calculate total debt. All right, we want to see how much debt we have in total. Then we want to look at that in terms of leverage. Like I talked about before, what is our leverage as a multiple of EBITDA? What is our leverage? What is our debt as a percentage of our total capitalization? All right, so this is an important number. The one thing we would need to make sure we do, don't just hit Alt equals, because if we do that, we're not including the revolver. All right, the revolver is still a piece of debt. We haven't put the number in there yet, but for my total debt formula, I want to capture that. So I'm going to say equals sum F17 through F20, the revolver all the way through my unsecured notes with warrants. Hit enter. You should get $270 million. So we have $270 million in total debt. And again, one thing I want to do is I want to calculate what is my leverage as a multiple of EBITDA. I can actually copy this cell and use a paste special formula right here. In cell G21, I can use Alt-ESF. If I hit F9 to recalc, it will give me leverage as a multiple of EBITDA. It'll add all these up and keep that format that's been pre-specified here. So you should still have an X after it. And again, when you paste, you want to use Alt-ESF and not just do a straight copy and paste. Next item, sponsor equity. In this case, we're going to hard code this. In this case, we're going to put in, as a private equity fund, we're going to put $104 million of our own funds into the deal as equity. So I'm just going to I'm going to enter 104. I'm going to hard code this. Now we could set it up another way. Remember, we've got the revolver set up to pick up any shortfalls. We could also set it up to have any shortfalls get picked up by equity. That is, if our lenders come back and say, you know what, instead of $270 million, we're only going to give you $240 million. If we change that, then our equity would get automatically picked up. It would automatically pick up that extra $30 million. So you can do it either way. We've just had the shortfall get picked up in the revolver. Last thing we need to do, now that we have all of these other numbers, we can figure out what is our revolver going to be. It's going to be 0 at closing. Okay, so for our revolver, it's going to pick up any shortfalls. What that means is I want to take my total sources minus my sponsor's equity, minus my unsecured notes, minus my senior bonds, minus my term loan, minus cash. All right, so again, this formula here, it's going to pick up any shortfalls that we need in our sources. Take my sources minus my equity, minus my unsecured notes, senior bonds, term loan, cash. Do not subtract total debt. If you subtract total debt includes the revolver. You'd have a circular inside of a circular, and Excel might not like that. Okay, so set it up the way I have: equals F23 minus F22 minus F20 minus F19 minus F18 minus F16. And again, it's 0, but if you set this up properly, let's check and see if this will work. Let's say we decide we only want to put 100 million in instead of 104. When I hit F9, now that 4 million gets picked up in my revolver. I reduced my equity commitment by 4 million. I'm borrowing that on my revolver. So that's how that works. And again, you could set it up so that difference gets picked up in equity, probably how you might do it in the real world. That's just an example here. Okay, once we have the revolver, now we can calculate what does our revolver represent as a multiple of EBITDA. Again, it's 0, so the revolver outstanding is 0, so it's going to be a 0 multiple, but I want to set it up here anyway. So if I change my model later, it will automatically get picked up. And it'll simply be equals F17 divided by EBITDA, B6. Okay, now again, we sometimes speak of leverage in terms of multiples, sometimes we speak of leverage in terms of percentage of capitalization, so we're going to calculate that next. Basically what I want to do is calculate as a percentage of the total sources, what does each individual line item represent? Right, so and we're just going to work straight down. For cash, I'll say equals F16 divided by F23. Before I hit enter, I'm going to copy this down, so I want to lock on F23. That is, I want every single line item still be divided by F23. So I want to hit F4, lock on that. It should say equals F16 divided by $F, $23. And then we can hit Control-C to copy. Can select all of our destination cells, which is each individual line item here. And then I want to use, again, Alt-E-S-F. I want to paste the formulas, not the formatting. I want all of this formatting to stay intact. These underlines, these borders, the bold formatting down here. All right, so if someone asks us, what is the leverage in the deal? What's leverage as a multiple of EBITDA? It's 4.5x. What's debt as a percentage of total capital? It's 72%. Two different ways to express our leverage. All right, next item we want to do, we need to specify our interest rates on each piece of our debt. These are going to drive our debt schedule. So we need to specify what these are going to be. If we look at our assumptions, if we look back through the assumptions under sources, it tells us that our revolver is going to pay cash interest at 7%, or we as the private equity firm are going to pay 7% interest in cash for any revolver borrowings we have outstanding. Our term loan, the interest rate will be 7.5%. Our senior notes will be 9.5%. And our unsecured notes with warrants, as I mentioned earlier, there will not be a cash interest rate associated with it. Put 0 there. We're paying our interest in kind. Right? That is, it does not get paid each year in cash. Instead, it gets accrued to the ending balance of the debt, and it keeps accruing over time, like a negative amortizing loan in real estate. So for unsecured notes with warrants, our cash interest rate should be 0. Our PIK rate should be 10%. But remember what we said about this mezz lender. They're going to get something a little bit more than just their interest and their principal back, because that interest will get paid. Right? Even though it's paid in kind, ultimately it will get paid when the private equity firm sells the company on exit, and part of those cash proceeds will pay out that interest that has accrued over time. Right? right, but in addition to interest, in addition to that principal, they're going to get a 5% warrant. In other words, at the end of the day, when we figure out how much equity, how much cash is left over to go to equity after we've paid off our debt, after we've paid fees to sell the company at the end of year 5, at the end of that, 5% of that remaining cash, that distributable cash, will go to our unsecured note holder. They own 5% of the company on the back end. And we can put NAs here for each of these. You could leave them blank. Probably better just to put NA so that someone doesn't wonder if you missed something. But that's what our sources and uses table should look like. Sources are 374, equal to uses of 374. We're going to fund the deal by raising $270 million of debt. We're going to put in $104 million of equity. Our debt is a 4.5 times multiple of EBITDA. That's our leverage. It's also 72% of capital, of total capitalization. We've got our interest rates on a cash basis, on a PIK basis, and we've got our warrants specified. So we basically finished our source and use table at this point.